All right. Wow. Time flies. I'm just sending a message here. My name is Andrew Stotz, and I want to welcome you into this all-weather strategy meeting. And first, let's have a little espresso. Hopefully, you're having a nice cup of tea, a cup of coffee, a glass of water, a sandwich, cow pot, whatever you're having. Welcome to this edition of the show. It's the 13th of January, and we're going to be talking about all-weather strategies and the performance. And most importantly, at the end of this, I'm going to be talking about my thoughts on China. And as you know, my positioning right now is overweight China, which has brought a lot of questions. So remember, you can ask any questions that you have as we go through this. Just type them in the chat, and I'm happy to answer them. Before we get started, let me just welcome everybody on. And I see Krit Pawarit. Okay, good afternoon. And Mio says, good afternoon, Uncle Andrew. Oh, all right. Pakan says, good afternoon to John Andrew. Good to see you guys, and good to see everybody here. We're going to be talking about the performance. This is our first time meeting in 2025. And so I'm happy to see all of you. And I'm going to just switch my camera for a second and look at the camera from this angle and go back to that angle. Good to see you guys. So I'm going to share my screen, and then I'm going to get started in just a moment. So Tarinrat, good to see you. All right. So we're going to be talking about the all-weather strategies, and this is going to be the update for December. We're going to be looking at the performance for December and, of course, for the full year. So remember to ask your questions in the chat. I love to get questions, and I know you guys have always asked me a lot of questions about my opinions about things, and I appreciate it. Remember, I'm not your financial advisor. In fact, I'm not a financial advisor. I provide this strategy to FINNOMENA, and then they provide it to their advisors and to you. So if you have any specific questions about your situation, make sure to talk to your advisor at FINNOMENA. So remember that our allocations are global and they're long-term, right? We're trying to gain from long-term equity. And I'm going to take myself out of this. Let's see. Can we do that? Ooh, that's kind of interesting. Just try to move myself out of it. But so, and also remember, we're diversified across asset classes, regions, sectors, and the like. So remember why we're here. I always like to start with this, that we're here to build wealth over the long term. It takes time to do that. So there's 6 pillars of investing. The first one, these are pillars that I see about investing. I'm going to move myself out of the screen here. Hold on one second. Okay, that's good. Down at the bottom. And the first one of those pillars is to invest in stocks. Over time, stocks have generally outperformed bonds and gold, offering a share in the value created by company management. And that's what we love about stocks. Also, number 2, reduce risk. Diversify your portfolio across companies, sectors, countries, and asset classes to minimize exposure to any one area. Number 3, contribute regularly. Reduce stress with dollar cost averaging. It is a great way to invest. Investing a fixed amount regularly can leverage market volatility, lower your costs, and boost long-term gains. Number 4, stay invested. You got to think long-term, be patient. The benefit of compounding happens over decades, not years, decades. And you've got to maintain discipline. I love this picture. Follow your investment plan to avoid acting based on emotion. And finally, number 6, continue learning. Enhance your investing skills by staying informed and learning from successes and failures. So we create these strategies for many decades. However, not even a decade is long-term. This was me when I was growing up, and this is me when I came to Thailand, and this is me when I'm 100. I hope I looked like that. Now, our aim is to create strategies that perform over many decades. Now, remember that outline most of these principles in my book, How to Start Building Your Wealth Investing in the Stock Market, which is available in both English and Thai in bookstores in Thailand and also through my online course. So let's get into it. Our target is to deliver steady returns over the long run. AWS launched in February 2019, and we target a 6% average annual return. We're not swinging for the fences. If you want to get a really high return, it's better just to go all equity and then hope that you can get that great return and not too much downside. And All Weather Alpha Focus, we launched in October of 2021, and we target an 8% return per annum. And finally, All Weather Inflation Guard, we launched in July of 2022, and we target 4% per annum. Now, from when we started the All Weather Inflation Guard in July of 2022, the strategies are performing almost as expected. Recent rankings show that moderate risk AWS slightly outperforming high risk All Weather Alpha Focus, while low volatility All Weather Inflation Guard delivered the lowest return, but it also delivered the lowest volatility. You can see that green line just very, very stable. Here, you can see that since July of 2022, all strategies have had lower volatility than the others. Now, let me just get online here with my team, just in case you have questions. I want to make sure I'm receiving them. All right. And we mix asset classes. So I'm going to remove myself from this for a second. Of reducing equity drawdowns. And you can see that the problem is you're going to reduce the drawdowns as we see in the beginning part of this chart, but you're also going to miss some of the booms in the market. Again, if you really want those booms and you want to ride those waves in the market, it's better just to own straight equity. Our strategy is a careful strategy that we're implementing over a long period of time. So before we do that, let me stop sharing my screen for a second and come back into the group and welcome everybody who's just arrived. I'm going to have another sip of espresso. What are you drinking? Coffee, tea, water? I like to drink a liter of water on a regular basis, maybe a couple of them a day. I've also recently fixed my books. I don't know if you noticed, but I made a lot of changes over the new year. So remember, you can ask your questions about anything that I discuss in today's session or anything else. Yeah. So Crit Powerit says water. Yeah, a lot of water. That's key for sure. Okay, let's continue on. So let's talk about All Weather strategy, which did fall by 1% in December. I think I put the wrong number there. Performance review, our strategies in December. So right now we are weighted 65% in equity, 25% in gold, and 5% in bonds and commodities, respectively. Also 25% in China. Now, since inception, the strategy was up 46.8%. And that's 19.1% above 60-40. And again, this is our best estimate after fees. So now in December of 2024, the strategy was down 1%, which was 1.9% above the 60-40 portfolio. I'm going to remove. I want to remove my. I don't know why it keeps going. So now our 25% target allocation to China did great as China rebounded. But our 25% allocations to U.S. equity and gold were a drag, though gold was better than world equity in December. So let's review the strategy. it beat a 60-40 portfolio by 70% or 7% in 2024, which was good performance, I would say. And if we look at this table, we can see a cumulative, what I would call value added at about 19% over the period of these 5-6 years. It's been a while that we've been going. Now let's talk about all weather alpha focus, which fell by 3.9%. It was hit hard for sure. So we're 95% in equities and 3% in bonds and 2% in gold. Now, since inception, the strategy was up 1.2%, which still is better than the 60-40 portfolio that we are trying to beat. I would like to see this one performing better, and I hope it will as we see eventually momentum coming into it. Now, it was 4.5% though below world equity, but with a lot less volatility. As you can see, the green line actually is world equity, and we can see less volatility in the red line, particularly on the downside. Now, in December of 2024, the strategy was down 3.9%. It was a crushing blow, which was 1% below 60-40, which was down 2.9. So it was a rough month. Our big tilts to Asia Pacific, ex-Japan, and tech outperformed world equity, but our tilt to precious metal miners constituted a massive drag on performance. I'm sorry to say that our allocations there just didn't perform the way we had hoped. It hurt performance. Now, even despite that, the strategy beat a 60-40 portfolio by 3.5% in 2024. So we still were able to get some performance out of it, but December was a hard month. And now let's look at all-weather inflation guard, which fell by 2.3%. Now, this isn't a very volatile one, and so that's a huge move. Let's look at it. We were only 30% in stocks, 60% in bonds, and 10% in gold. Since inception, the strategy was up 7.2%, which is not bad, and it's better than the 40-60 portfolio. In fact, it's about 7.3%. So we're happy with that performance. The strategy has also experienced less volatility. But let's just look at the month of December. The strategy was down 2.3%, which was 0.7% above the 40-60. And so we can see global bonds fell, money markets and tips held up. Our 5% allocation to infotech and 10% allocation to gold did better than world equity. And our 5% allocation to financials was a big drag. You can see 3.8% down. Of course, with inflation guard, we have a much lower level of risk. And let's go back to the slide before where we can see we're only 30% equity. So we're trying to reduce the risk there. So the strategy beat the 40-60 portfolio by 1% in 2024. And for me, this is a really hard one to beat because we are very low on the equity portion. But if you look at the cumulative, we can see that it's been 7.3% since the beginning of what I would call value added. So that gives a little breakdown on performance. Before I go into our contrarian China overweight, I'm going to take that out for a second and just say hi to everybody out there. Remember, if you got questions, feel free to ask. We're together for another 40 minutes or so. New T says, I got a cup of coffee. It's the best. Okay. And Sunosuke Nohara. Sawadee krap. Sawadee krap to you. ABB says, Happy New Year, John Andrew. Happy New Year to you, ABB. And I love the hippo picture. That's cool. Toss Upon says, good afternoon, John Andrew, and good afternoon to you, Toss Upon. Good to see you. And Pokin says, John Andrew, I would like to follow AWS, but my investment is in RMF. Do you recommend to follow your strategy? I can try finding the same funds or similar exposure in RMF myself. Well, definitely with RMF, you can get, you can get tax benefit, and anytime you can get tax benefit, it would be great. So always go for tax benefit first. But mine, after you've exhausted the tax benefit, then all-weather strategy is a choice. Now, I have been asked by some people, could we put all-weather strategy in a fund and then apply a tax savings to that fund? I'm considering that. But for right now, we haven't done that yet. But anyways, I don't think, I don't have the RMF for all-weather yet. So, but always take the RMF or any other tax benefit that you get, right away. So welcome everybody. We got 199 people on the ticker that I see. So welcome everybody to our first meeting in the year of 2025. I just had a nice espresso and my mom's in the other. Okay, hopefully you're still there. My electricity went out and I'm going to try to continue on with my presentation. I ended up going onto my mobile phone to try to come on screen. So hopefully it's working right now. And I'm going to go back to where I was. And I was talking about China. So let's bring that back up on stage if I can get it. Okay, whoops, there we are. So I wanted to go through China, and I think we're back online now, hopefully. Yes, and Pokin, I want to talk with the folks at FINNOMENA about this because I do think there's a possibility that we could do this. So hopefully that's something we can do in 2025, by the way. All right, and welcome everybody. Hello, Supercorn, good to see you. And all right, let's go. So let's talk about China. In early December 2024, we increased our weighting in China to 25% from 5%. This was a contrarian move and still is. So China did well relative to world equity in December, but it's fallen back in January. And is China still attractive? That's the question, right? So let's first look at what we said in December. It's a huge victory for Trump, and Republicans won the Senate and the House as well. And Donald Trump is scheduled to be inaugurated as the 47th U.S. president on January 20th. My goodness, that's only 7 days away. And what we said was America first means likely more tariffs on Chinese goods. Trump will start by hitting China hard to get the Chinese to play ball. And in a good scenario, this leads to reducing the U.S.-China tension. That's part of my argument here, is that what we can see is that Biden and his administration were just absolutely anti-China. And they were ready to go to war practically with China, whereas I believe that Trump is trying to punch them hard, but then come up with a solution. He doesn't want to have a prolonged war with China. And I believe that China will go along with that. So, also we said that Chinese stocks have started to move. China continues with easy monetary and fiscal policy to stimulate the economy. And it's just still unclear if the economy has bottomed yet. Now, the latest announced stimulus package aims to get local governments to refinance some of their hidden debt, and this should reduce the interest burden of local governments and unlock some spending. But, you know, I'm not here telling you that China is going to really come roaring back. There's still so many issues, right? But new stimulus announcements can be catalysts in the market. And I also said that Trump is likely to play hardball with China and threaten with or impose more tariffs. However, Trump is looking for a deal, not a war. And the Chinese government seems to be prepared to deal with tariffs, and Chinese companies have done business under tariffs before. And much of the negative, I would argue, is already priced into China. And so I think there's more opportunity for upside surprise than downside surprise. And therefore, we're raising our allocation to 25% in China. If you've got questions about that, make sure to ask those questions in the chat. So, Chinese government bond yields, of course, are crashing, as we can see. Falling bond yields can signal expectations about slower economic growth, definitely slower expectations on inflation. And therefore, you know, China's going through a down cycle. But is that anything new? I mean, we've been talking about that for a while, and the markets have been talking about that. And the falling bond yields likely reflect the deflationary pressures in China. As we can see, China has been in a deflationary period for a while. China is facing also, of course, a property crisis. The Wall Street Journal estimates that nearly $8 trillion has been wiped out in 3 years. It's incredible. And we can see that China residential property prices have indeed come down from 113, as we can see, to 97 from that crisis time. And China's indebtedness has surpassed the US. As we can see, that indebtedness is now up to 292 as a percent of GDP. Together with previously mentioned reasons and demographics, this makes people ask if China is the next Japan and the market's not going to come back. You can see that demographics can worsen deflationary pressures and property prices in the long run. China is to see an 8% fall in population by 2051, and the labor force is expected to contract by 23% as we see more and more people getting older. Still, in 2051, China is expected to have 761 million people in the labor force, just the labor force. So part of what I would say is don't write off China, of course. For comparison, EU and US combined are expected to have 621 million in the labor force. Now, currently, the youth unemployment in China is at a record high. It's credible. It's sad where youth unemployment is. So China isn't only challenged in the long run, but also right now, trying to figure out what to do to get people back to work. Now, for my decade as a bank analyst, which I was from 1993 until 2003 during the banking crisis of Thailand, I say banking crisis always starts with property crisis. Why? Because property is collateral for loans. And when times are good, banks give loans based on the rising value of collateral. And when crisis comes, companies can't pay. But to make matters worse, the value of that collateral starts to fall. And this makes it difficult for banks to recover their loans, which can lead to a bank crisis. And this is a real risk for China, for sure. And that's the reason why the banking sector is not performing well. And it's also the reason, the other thing to think about is that the banking sector is a large portion of the overall market. If banks don't perform well, it's going to be hard for the Chinese stock market to perform well. Now, China isn't cheap. Chinese financials drag down the valuation of the market. Now, here you can see the green bar is China excluding banks. And most people are thinking when they look at the Chinese market that it's trading on a 15 times PE, or let's just say, let's take, actually what's interesting is how much this has come down. But let me just grab my pen here for a second. And what we can see is that the gap between the banks and the market is shrinking here. We can see. And if we exclude banks, the Chinese market has definitely come down right there to about 14 times or so. And China financials trade significantly below book. Now, this was price to earnings. Let's look at price to book. And here we can see that if we look at Chinese financials, we can see that they're trading at about half times book almost, let's say 0.7 times price to book. And we can see that when we exclude the banks out of the index is trading at 1.5 times price to book. So, but are you the only one with this information? Are we the only ones that know this? No, we're not. You're not alone. Everyone has this information about China. And this is one of the questions I ask my students in the valuation masterclass is it in the price? And it is. It's already in the price. All the negatives about China are already there. And one thing I would highlight about China that I think is quite significant, I'm just going to come out of this for a second. One thing I would highlight about China is that China, remember, if you go back to 1997, when Thailand was going through its financial crisis, basically 25% of the loans of the Thai banking system in 1997 were foreign US dollar loans. So what does that mean? If the world wants its money back because they don't trust Thailand, they're going to want to take that money back. And then Thai companies are scrambling to try to pay that back. But in the case of China, China's not funding its growth by borrowing outside of China. So they don't have the same pressures that we had during the Asian financial crisis. So let's talk more about what we're seeing in China. So let's turn the tables. It's likely that China is going to continue with stimulus in different versions to fight deflation. We can see here, the red line is China's deflation, which we showed before, and it didn't go through the inflation cycle and then the deflation cycle that the US, for instance, went through. So while deflation is negative for the economy, new stimulus can boost stocks in the near term. And China and US government bonds yields are moving in the opposite direction. US bond yields racing up as risk is rising for the US, and Chinese bond yields are falling. Is risk falling in China? Well, to some extent, when the market's not doing well and everybody knows the economy is not doing well, you could argue that the risks have been falling now in China. Investors are okay with 2% in Chinese government bonds while demanding 5% in the US. Now, again, like I said, the Chinese bond market is not as liquid, let's say, as the US bond market. So the US bond market has a huge amount of foreign participant. The Chinese bond market doesn't have that level of participation. So it's not like people are saying, well, I could do China or I could do US. But here you can see that the average investor is demanding more from the US than they are of China. China can finance its debt much cheaper. So for instance, if the government wants to borrow money to stimulate the economy and stimulate infrastructure and the stock market, it can borrow money now at very low rates, particularly if it can do it with long-term debt. They're doing it at a super, super cheap rate. That was a mistake that the US made Janet Yellen should have been borrowing money with 20, 30, 40, 50 years maturity at super low rates, but she never did. She did it all at the short end of the yield curve. So do investors prefer China, or is it simply reflecting inflation expectations? That's a good question. Now, post the global financial crisis, property prices in China haven't been nearly as inflated as in the US. This is a crazy chart. So you can see in this chart, I'm just going to explain what I've done. Rebase this to 2010. So let's say 2010 right here, I'm going to take 100, going to carry this over to about right here, about 2010. And that point, we rebased it. But what we can see from that time of the financial crisis of 2008, we can see that basically it has shot up. And it's been flat in the US for a while, but China went up a bit and then it fell. So this chart helps us understand that, though the Chinese property market, is painful, the fall is painful in the property market, I would say that actually it's possible that Chinese property prices have not been nearly as inflated as US property prices. So the property crisis might not end up being as severe in China. And though we still consider it's a risk that the property sector could lead to a banking crisis in China, we have to remember that Chinese government has massive access to funds, and those funds can pump up the banks and pump up the economy. So when I look at the Chinese banking sector, yes, it's in pain, but is it going to crash, or is it going to crash the economy? I'm not convinced that that's the case, because number one, first of all, banks have already been deflated. We can see in the market. So the risk is down in investing in banks. So that may attract more money into banks so they can raise capital. The second thing is that the amount of the fall in the property market, though big, is not nearly as much as the potential for the US. And then number three is the Chinese government always has the power to inflate and inject money into the banking sector, take the bad loans off the banks, and then get the banks back to lending. If they announce a program like that, the stock market should fly. And so again, the question is, what's in the price? And I would argue that almost all the negatives about China are in the price. Could it go down lower? Yes, it could. Now, if AI is taking over, demographics may not matter in the same way as before. Here we can see the cumulative share of granted AI patents. This is from 2010 to 2022, and we can see 61% in China. That China has the most AI patents may be a quantitative rather than qualitative statistic. Either way, it shows how much the Chinese government cares about AI. Considering many factors, China ranks second only to the US in the world. And I'll just tell a brief story. I was talking yesterday, I was interviewing along with other faculty members at Thammasat, the incoming students for the new term for Thammasat. And this is for the Thammasat Business School for the BBA program. And we talked a lot about AI and we talked about education, but one of the applicants was a young lady from Chiang Mai. She was actually from Praia, I think. And I asked her, how old are you? And she said, I'm 16. I said, you're applying for university when you're 16? She said, yep, I got my GED, I passed, and now I'm ready to get into university. And I wondered, what's the minimum for Thammasat for BBA students, which I found that there's not an exact minimum, but around 16 is where it ends up because they can't get their GED beyond 16. But the reason why I asked that question was because when I did my PhD in China, I was at the University of Science and Technology of China. There was all these young kids in a group at one place. And I said, why are these kids come to the campus? And they said, those are the gifted students in China. And some of them are as young as 8 years old that are attending this university. I was like, oh, China really, really focuses on getting their youth, the top people, educated well. So China definitely focuses on AI and technology and the like. So as we've seen, China ex-banks is still cheaper than the US. So even if we exclude the banks, so let's look at the green line and we can say, Here's China's PE, excluding banks. Remember, banks are the blue line down here. It's still very cheap compared to where the US is. And looking at price to book, China looks even cheaper than the US. US is crazy when you see how high their price to book is, which is almost 4.5 times versus China, which is at 1.7 if we exclude the banks. Of course, if you include the banks, because the banks always have a very low price to book of about 0.5, we can see that the amount of the overall market is about 1.2, 1.3. So let's talk about something else that looks good for China. China produces a third of the cars in the world. It's incredible what China has done. You can see the red line is China, which went from 13% to 32% of global motor vehicle production. China is also a leader in EVs, so much so that the EU and US imposed tariffs on Chinese EV imports. China has 75% of battery capacity and is expected to still hold 68% by 2030. If the EU wants a green revolution, they're going to have to do it with China. Batteries are vital for EVs and the green transition. No one is even near China's capacity. So in summary, we think China could continue to outperform in the next 2 months. There's a lot of negativity surrounding China, but I would argue it's probably in the price. And there's also opportunities in other angles. Given that the Chinese stock market has been pushed down, we think there's some good upside potential. New stimulus is a near-term catalyst, and we see and take into account the long-term risks, but we make our allocations, remember, on a 3-month basis. So I'm not necessarily saying that China's going to be great over the next 5 years or 3 years or even 1 year, but we are allocating and reconsidering our allocations every 3 months. So that wraps up my section on China, and I'm happy to take questions on that. But before we do, and before we get into Q&A, let me remind you, Valuation Masterclass Bootcamp number 20 starts on the 3rd of March, 2025. We help finance professionals become valuation experts in months rather than years. And we have many previous attendees coming from FINNOMENA. Here are some of them, whether they're advisors like Chachada or Tosapon, Takon, Jutamas, a client, Bunsim, a client, Pongsakon, also clients. And in Valuation Masterclass Bootcamp, you get a 6-week guided intensive online valuation bootcamp, daily live sessions, team support, progress tracking, and you get to write and present a professional valuation report. Get an extra $100 off at any price point for FINNOMENA viewers. That's you. Or what about your kids? Maybe you need to get them understanding finance. So that wraps it up for this section. I'm going to now switch and go into Q&A. So please send any questions that you have about this presentation into the chat, and I'll do my best to try to answer it. All right. Oh, it seems like Supercon is really got a lot of questions. But I did get another question. Another point is support the tax savings fund for AWS. Yep. In Phenomenal Web, they show Inflation Guard return 10%. Can you share how to calculate? Actually, I'm not exactly sure how they're calculating in their system versus how I'm calculating. There may be some small differences. So I don't have a great answer for that. But let me just look at one other thing here. I'm going to switch my camera over to this side, and I just want to look at Inflation Guard for just a second. Okay. So they're showing a return of Inflation Guard of 10% in 2024. I'm not sure if that's correct. I got Alex on the line, so I'll ask Alex to help us, but I think that's unlikely that that's correct. Okay, let's go to some other questions. In your valuation model, does momentum is the same as technical analysis, or it's not the same? Well, the way I explain the momentum factor in FVMR is momentum is both price and fundamentals. So it could be something like earnings growth momentum, but it can also be price momentum. And when the price momentum component, when we're calculating that, you could say it's like technical analysis. I'm not against technical analysis if it can help us improve our stock picking and our allocations. Also from Supercorn, lots of questions about the model today. Okay, so in model allocation is bonds. Does that mean only government or include corporate? Mainly government. And the reason why mainly we're focused on government is because, remember, we're using the bonds to try to reduce the risk of the stock market. When the stock market collapses, we're hoping that our bonds and our gold will protect the downside. So we're not trying to pick up yield by owning corporate bonds. It's mainly government bonds. I hope that answers the question. All right, another question. Keep your questions coming, by the way. Pokian says, another question. With all due respect, and sorry to ask this, when do you plan to retire? I saw a post of your 59th birthday. After your retirement, will there be a successor to manage AWS? That's okay. That's a great question to ask. And I want to tell you a story, Pokian. And in order to tell this story, I have to get a book off of my shelf. And that book, somewhere over there, but I won't be able to get it right now. But that book is given to me by my father. And it was the last book that my grandfather wrote. And inside that book, and let me get that book. Hold on 1 second. Hold on. Let's see, give me this book right now. Hold on. I'm getting that book. I didn't run away. Hold on. Pokin, hopefully you'll appreciate this story. Okay, so this is his last book, and it's called Outposts for the War for Empire. That was my grandfather. You can see his last name, same as mine, Stotz. And his name is Charles, and my middle name is Charles. In that book, there is a piece of paper, and the piece of paper says, congratulations on finishing your final book, Charlie. This was a short message from the publisher. And the publisher said, here is the first book off the printing press. Congratulations. That was when my grandfather was 87 years old. And my grandfather died 2 weeks later. In other words, my grandfather worked until almost the day he died. And I believe, for me, I want to work all my life until the day I die. So from that perspective, I'm not going to take any retirement at 60. Why would I do that? I love what I'm doing. And so the answer to your question is that I'm going to continue what I'm doing. In fact, I'm going to up the game. In 2025, I'm going to start going live and go out and talk more and more about what we're doing. And so there is no succession plan for me based upon retirement. Now, if something happens to me, let's just say something happens to me. If something happens to me, basically my business partners, Sornsa and Alex, are going to meet with the Phenomena folks and try to figure out what's the best way to go forward. But let's just say that they all decide, well, let's just stop. Well, if that happens, we stop the allocations. You have your portfolio. Nothing's going to happen to that. That's your portfolio in your account. And then you make your decision about what you're going to do next with that portfolio. So I don't see a major risk for you in what we're doing, even if something was to happen to me. So that's a great question. And hopefully I've answered that question reasonably well. Remember to ask your questions. We got a little bit more time, so I'm happy to take any other questions. Supercon says, with recently NFP show, U.S. economy goes strong, as well as Trump's administration will lead to long high rate and inflation increase. Any impact for allocation in the next round of adjustment? So right now we are at a 25% allocation to the U.S., which is a slight underweight in the U.S. I think the U.S. market is very expensive and very high, particularly the top companies. If you look at the mid and small cap companies, they're in pretty, they're relatively cheap. And so I would argue that the risk of the U.S. market is on the downside. Now, That doesn't mean that Trump won't try to pump up the market. And I think Trump will try to pump up the market. I think he's going to try to push the Fed to reduce interest rates, to bring down rates and try to pump up the market. He's going to try to cut taxes or extend the tax cut that he's done. He's going to be announcing a lot of different things going on. And so I think those things could push up the market in 2025. But to a point, it's the same question about the dollar. I would also argue is that there's probably going to be some strength in the dollar as people see Trump and his team trying to do everything they can to strengthen the dollar, particularly by trying to deal with all the government spending. But eventually, I think we're going to see the dollar eventually weaken. But for right now, we could see the market strong. We could see the dollar strong. And that's the reason why we're not moving our allocations to US to 5%. But to move our allocations to in the US to a much higher percent from here, I think is a big risk. So that's one of the reasons why I can see we're not getting it. So how about your view on the Korean index? Korea is always cheap. So you have to be very, very careful. In fact, I wrote some pieces on our Become a Better Investor blog, and those pieces talked about Korea always being cheap. And the reason why Korea is always cheap is because corporate governance is an issue, so people aren't willing to push up the price. But also the other thing is that the ROE, the return on equity of the Korean companies, is pretty low. So now I will add also that in AWS in particular, we don't have Korea because it's much bigger. AWS is only looking at individual markets, US, Japan, and Europe and China. Korea is a much smaller market than that. In Alpha Focus and in particular, we can look at Korea, but as of right now, it hasn't come up on our screens. Supercorn says, will you see more potential move war in Trump? No, I think anybody who thinks that there's going to be more war with Trump has probably got it completely wrong. There's going to be less war with Trump. The first war that's going to stop is Ukraine. That war will be over in a month, is my prediction. And the next is Israel and, what's going on there. And I suspect that Trump's going to put some pressure on them to stop what's going on. So I would argue that, and also if you think about Trump in terms of China, he's not trying to go to war with China. He's just trying to get China to play the game of his negotiations to get better terms for U.S. businesses. Now, is he starting a war with Canada? No, Canada and the U.S. are never going to go to war because it would just be ridiculous. And America has so much more power than Canada that it just wouldn't make sense. I'm not exactly sure where Trump is coming from in the way that he's kind of harassing Canada. If he wants Canada to become part of the U.S., it's not the greatest way to do it. But part of what's happening, Supercorn, is that if you look above Canada, you have the transit ways for ships. And basically, as that has opened up over the years, he doesn't want Russia and China getting control of those transit ways for ships. And so the result of that is that the U.S. is providing a lot of support to Canada to try to protect those shipping lanes. And what he's saying is that the U.S. is spending a lot on that, and Canada is not really supporting itself. And if Canada was part of the U.S., it would all just be one place. As far as Panama is concerned, I suspect he's going to get control of Panama pretty quickly. And the reason, and I'm talking about the Panama Canal, not the country Panama, but just the Panama Canal. And that's because the U.S. gave the Panama Canal back to Panama. I think was it under Carter? I can't remember what president was under, but they gave it back to them. And now he sees it as, hey, if we don't take control of the Panama Canal, what's going to happen is China is going to control the Panama Canal through all kinds of political connections and relationships. And he doesn't want to see that. Now, as far as Greenland is concerned, I think very quickly, before the end of 2025, the U.S. may have control of Greenland. And part of that is that, it's hard to resist for Greenland. They would probably rather be under U.S. than under Denmark. But the point for the U.S. is that, if you think about all the energy and all the consumption of energy that we have, and frozen areas are great for reducing the heat of all the power that's being generated, number one. So AI centers and all that could be in Greenland, but also the amount of raw materials and rare earths that are there are pretty significant. And so I would say Panama and Greenland, yes. Canada is going to be a little bit harder. Okay, I think we've included this reminder that there's $100 off with the coupon code. Just use FINNOMENA valuation masterclass.com/bootcamp. Now, how do you view equity collateral also leads to a crisis? No, equity collateral doesn't necessarily lead to a crisis because equity collateral can be liquidated pretty quickly. And they're going to, if you can't pay up for, the fall in the equity collateral, the collateral can be liquidated. So yes, if there's a lot of liquidation of equity collateral, then it can put downward pressure on the prices of the stock market. But remember that majority of collateral is property. Majority of collateral is land. Okay, regarding China's situation, is it the right time to buy more of China fund if I have now 40% loss? Yeah, it's so hard to think about any investment when you're sitting on a loss. But let me tell you the way that I think about this. I always look at our allocations as if today I have zero allocated to these markets. Zero. Everything is in cash. How would I allocate my money today? And once I've made that conclusion, then that's what I do. And that helps me because, I make mistakes. You can see that the gold miners, as an example, got hit very hard. I made a mistake. It's hurting us. It's hurting our performance. But you can't let yourself get caught up in your mistakes. And so what this is called is zero-based thinking, where you go back and you just think, if today I didn't have that investment in China, would I invest in China? And my answer to that right now is I'm overweight China. Will that overweight last more than 3 months? I don't know. So I can't answer this question. And I do think that you've got to talk to your advisor about it. But what I would say is that every investment, so a lot of times when we don't sell an investment, we think that we're safe, just let it sit. But the fact is we're losing the opportunity to grow that money. So think carefully about that. ABB says, your view on Trump 2.0 victory about Canada, Panama, cancel, and Greenland. Yeah, so I've given that view. Hopefully you've got that now. What is your view on US dollar and interest rates during Trump time? I think Trump is going to put tremendous pressure on the Fed to lower rates to as low as he can possibly get them, to pump up the economy and show that he's made a huge impact there. And if interest rates come down and the economy goes up and the stock market goes up, I think that we are going to be in a period of time where we will see that the US dollar remains strong. Does the US dollar remain strong for another 6 months, 12 months, 18 months? Maybe something like that. Particularly if the government, if the Department of Government Efficiency led by Vivek and Elon Musk were to really make progress, people would feel like maybe they're going to bring the debt level down. But I think my answer, and I learned this in Thailand, is never invest based upon government doing something. Okay, John Penn says, tomorrow I'm going to invest more in AWS. Good. All right. And what is your view on Vietnam? Well, remember that Vietnam is not an emerging market. It is a frontier market. So because it's a frontier market, it doesn't fit in any of our strategies because we only look at developed and emerging markets. So I haven't looked at Vietnam for a while, but I know that most people in Thailand love Vietnam. But for right now, it's not in my area of focus. Salia, that's a good question. What is FEMR for Thai market? I can't answer that right now because I can't remember. I haven't looked at the latest, so I can't answer that now, but I should come up with that and discuss a little bit. But as you can see, the Thai market is, been pretty much a disaster. Part of what's happening is earnings are collapsing, and as earnings collapsing, PE is rising. PE should be falling for the Thai stock market, but because earnings are falling, the PE ratio is rising, and that has to work itself out. So you can look at price to revenue, or you can look at price to book and try to get a little bit better idea on it. But I haven't looked at FEMR recently. All right, what's your view about India? Are there any bad news about India? The stock could go down every day. India has not come back into our portfolio for a while. And so as of right now, I'm negative on India. And so I'm not really paying much attention to it. But I would say ultimately what you can say is that I'm trying to ride some of the Trump wave for sure, but also trying to try to get some little bit of turnaround in the Chinese market. So Gan Long Tun says, many people worry about U.S. stocks are already expensive. It's still a good time to put more money in the U.S. Yeah, I mean, you can see my allocation is only 25%. The U.S. now is 70% of an equity portion. And if I'm 25% of our total assets under advisement for all-weather strategy, that means I'm about 38% weighted in the U.S. So I'm already weighted in the U.S. So to answer that question, my strategy is not putting more money into the U.S. In fact, I'm underweighting the U.S. So that hopefully gives you a picture. Number two, many people can sell LTF. Should they move to mutual funds in the U.S. or U.S. mutual funds? I would be careful about the U.S. at this point. I do think it can go up more with Trump pumping it up, but I do think that there's some risk there. So that's the reason why I'm not overweight. I'm underweight in the U.S. market. These are great questions, and we're about out of time. So I want to thank everybody for being on. We've got about 270 people on. My power went out, and I had to switch to my mobile phone for my internet, which worked tremendously well. Thank you, AIS. And luckily, we were able to get back on board. But I appreciate all the questions. Let's see if we got any other questions. Will you plan to separate Asia, North and South, as fundamental and industrial both seem totally different? Not yet. I mean, I am doing it North and South because I am separating, let's say, China out of Asia. So I am separating it in that way. And then for Alpha Focus, I'm able to choose Taiwan, or I'm able to choose India or the like. So let's just say I've already separated kind of by country. But in all-weather strategy, I only have China out of it. But in all-weather, I have more narrow instruments that I can get into. All right. That's it for today. I want to say thank you to everyone. And I appreciate you, and I appreciate your questions, and feel free to keep those questions coming. And I hope with Phenomena, every few months when we do our rebalancing, that we're able to go live at Phenomena on site and see you guys. And let's have some fun. Let's drink some coffee together, tea, water, or whatever, and let's talk about the portfolio. Meanwhile, I want to thank everyone for coming on today and appreciate your support in our strategies. Have a great day.